Hello, visionaries. Welcome back to my channel. My name is Maresa Talbert. I'm the founder and CEO of Talbert Law Office, your favorite go-to legal resource for all things business, nonprofit, and intellectual property law. I received a comment from a viewer asking me to discuss companies purchasing other companies. So today, that's what we're going to talk about.
My faith rising. I'm crawling out the trenches, holding me. My life.
Let's have a pop quiz. Here's the question. Can a person or a business purchase a sole proprietorship? Yes or no? Let me know your answer down in the comments.
A few moments later.
All right, we ain't got time like that, y'all. The answer is no. Why is that? Because a sole proprietorship does not create a legal separation between the owner and the actual business. If you got that question wrong, it's no shame. We're all here to learn. But I will suggest that you go back and watch my playlist on business entities. That pop quiz question becomes relevant when talking about a company acquiring another company. That's because it's important to be familiar with the various business entities, and then we have to understand which entity can own which entity. For example, it may be important for you to know that LLCs can own other LLCs, C corporations, and can even be a partner in a partnership, but it can't own S corporations. So that leads us into the fact that S corporations cannot be owned by business entities, except with one exception. S corporations can own other S corporations if they are the sole owner and they own 100%. On the other hand, just like an LLC, a C Corp can own other C Corps, other LLCs, and can also be a partner in a partnership. Understanding these various entities, their capabilities, and their limitations become crucial when considering to purchase an existing company. Okay, so let's jump into the real discussion. I'm going to give you the general steps for purchasing an existing company. Number one, you got to find a business that you're interested in purchasing. That can be based on your individual hobby, an industry that you're extremely familiar with, or a business that just presents as a good investment opportunity. Number two, you have to conduct your due diligence. You got to ask the right questions. Some questions that you should be asking before you purchase an existing business are the following. Why is the business for sale? What is the business's current financial status? Is it declining? Is it on the rise? Does the business have outstanding debts? How is the business marketed? What are the primary methods to attract customers? Are there any key or high value customers? And if so, what would happen if they stopped being a customer? Is there a diverse customer base? Meaning, are there more than 20 to 30% of the profits that come from a single customer? That would be important. When was the company started and how has it changed since it began? Does the business own any intellectual property? If so, do those ownership rights need to be transferred to the new business owner? Are there active contracts that the business is currently fulfilling? If so, you need to take a look at those contracts and see what the obligations of those contracts are on the business. Are there pending lawsuits against the business or any of its owners? Is there a strategic growth plan for the business? Those are some of the more general questions. However, there's still so much left to find out. You got to get into the details. The bank statements, the sales reports, the profit and loss statements, the tax returns. Depending on the business, you may need an inventory list or a supplier and vendors list, the customers list. You might want a business credit report, or you may even want to review or audit the business's social media presence or online customer reviews. As you can see, this list can go on and on and on. But the point is that due diligence is extremely important and cannot be overlooked. Number three, you got to determine the purchase price. So once you've conducted your due diligence, that allows you to get an idea of what the business may be worth. You can see any assets that the business has and what their liabilities are, and more important, what you're willing to pay for it. You may have a number in mind where you can just negotiate directly with the other party, or you may need to hire a professional to actually obtain a business valuation. And you can hire either an appraiser or an accountant to conduct that valuation for you. Number 4 is all about structuring the deal. This is where you'll decide how you'll finance the purchase. And there are a number of options. You could have an all-cash deal with no financing. You could have a seller finance transaction, which is an arrangement where the seller agrees to provide the loan to the buyer to enable them to complete the purchase. You could also have a traditional business loan with a bank or other financial institution. You could have an IP-backed loan where you use intellectual property as collateral to secure a loan. If you're unfamiliar with this type of financing, I have a video that I'll link up above and in the description box below. You should check it out. The point is that there are several options that may be available to you. Number 5, you got to negotiate the terms of the agreement. Contracts, contracts, contracts. This is so much more than the number after the dollar sign. In this stage, you are negotiating the particulars of the purchase. Are you just purchasing equity in the company? Are you purchasing assets of the company, or both? Are you inheriting any liabilities like a debt or again a contract that you are required to fulfill? Are there any regulatory compliance issues that need to be addressed, such as the need for an ABC license if you're purchasing a bar or a restaurant? If the seller has a current license for a particular industry, does that license turn over with the business, or are you as a new business owner required to apply for one? Let's take another example. Let's say that you are purchasing a restaurant, bar, and grill, and the alcohol license expires one day after the closing date of the sale. You'd find that out in step 2 during your due diligence, and you'd probably want to negotiate for the current owner to renew the license as a part of the agreement prior to closing. Those are the types of things that are really important to consider and negotiate on your behalf before a purchase is finalized. And last but not least, we're going to seal the deal. After we've found our business, we've conducted our due diligence, we've completed our valuation, we obtained our financing, and we've negotiated the specifics, it's time to get those documents drafted and buttoned up. Your documents include your purchase agreement, your bill of sale, your closing certificate, any IP licenses or assignments, and your post-closing documents, like an employee agreement. And that's how you seal the deal for purchasing an existing business. All right, that's it. Of course, let me know what you're thinking in the comments. Thank you for watching, and as always, this is Talbert Law Office, your favorite go-to legal resource for all things business, nonprofit, and intellectual property law. See you in the next video.
I done made it this far. I'ma keep it pushing, yeah.